If you're a high income earner and you want to save some money in your taxes, well, you came to the right place. Let's get into 9 ways to save on your taxes. Hi everyone, welcome back to your classroom. I'm Thatcher Taylor, owner of ProPath Financial, and I'm going to tell you 9 different ways that you can save money on your taxes. And you got to understand, no one single year is going to change your life by saving money with taxes. The real key, the real secret to tax success is how much in taxes you can save over your lifetime. That's the kicker, and that's what I'm gonna help start with today. As we're going through this, remember, there isn't a tax silver bullet. There isn't a way to avoid taxes every year at all times. The magic is mastering the fundamentals and doing them deliberately and specifically over and over again every single year and coming out on top. There is a supporting article to this video, so go to www.propathfinancial.com/9tax tips to read about this as well. First thing is maximizing retirement accounts. You gotta divide them up into tax deferral now and tax later, or tax now and tax-free later. So the tax reduction now and tax later are your pre-tax 401ks, your SEP IRAs, and your IRAs, your pre-tax 403bs, and potentially even 457s if you have them. All of these give you a tax deduction now where it reduces your taxable income, but you contribute to them. They grow tax deferred, and at some point in the future, you gotta pay taxes on all those earnings. But the reason you do that is because you seem to believe you're in a higher tax bracket now and you'll be in a lower tax bracket in the future, so taking the deduction now makes sense. The second bucket is the Roth bucket when it comes to retirement accounts. Roth 401ks, Roth IRAs, Roth solo 401ks, these are where you pay the taxes up front, but the earnings and those contributions, as long as you don't break the rules, which you probably won't, will be completely tax-free in the future. So this is the first example of, do you pay taxes now or do you pay taxes later, and what's going to be the best method to reduce taxes over your lifetime. All right, part 2 is tax efficient investing, but this is going to be 4 parts. So this is essentially 2 through 5. So 2A in tax efficient investing, and all of these are going to apply to taxable accounts or taxable brokerage accounts like trust accounts, joint accounts, individual accounts. And the first one is tax efficient investing. More specifically, this first part is location of the assets. High interest payers and high dividend payers, you want to try to put in retirement accounts because those interest and dividends are taxable in the year that you receive them. And if you're already earning a bunch of income, you might want to defer those taxes until a different time. So if you can get those ones in a retirement account, that's best for asset location. However, in your taxable accounts, you want to maintain lower dividend payers if you can, municipal bonds where the interest is tax-free, and growth stocks because you're not going to have much intra-year taxation. So making sure to have the right assets in the right place is going to help on that year-to-year taxation. Again, this is called asset location. I already got a video for this, so go ahead and check it out if you want to learn more. If you made it this far, thank you so much. Please make sure to go pound that like and subscribe button and hit me with any comments below if you have any questions. All right, 2B is don't be afraid to use taxable accounts. Too often, people refer to number 1 and they want to maximize retirement accounts. But one of your best friends as you try to mitigate taxation is being able to use a taxable brokerage account. Because remember, the money that goes into that account has already been taxed. So you get to really control what happens intra-year with how you are taxed based on capital gains, short and long term. In addition, you can control dividends and capital gains along the way. So being able to use a taxable brokerage account is phenomenal. I just ran into this today where a client needs some money to help a kid with a down payment on a house. They're gonna have to access retirement funds, which are gonna create taxable events. What if you could use a taxable account where you could really pinpoint assets that have not grown very much and you could really minimize your taxes to get some money for a family member? This is a really valuable tool. That's part 2B. 2C is tax loss harvesting. Utilizing taxable accounts really allow you to tax loss harvest. Everyone wants to talk about making money, which is great, but being able to harvest losses in a down year from an investment, you can offset $3,000 of income and or offset any capital gains or carry over into future years' capital gains and carry over that $3,000 if you're not using the capital gains is a very valuable tool in your planning process. It's very easy to take an asset that's lost money, sell it, and buy a non-substantially identical asset to be able to carry on the rebound, and you'll be on your way and you'll get some tax savings in the middle of that. Then lastly, 2D is tax efficient investing. Because you don't get capital gains that come from nowhere. If you have actively managed mutual funds in a taxable brokerage account, maybe trying to think about using ETFs and index funds, because they don't spit off capital gains if the fund managers are selling the assets. An actively managed fund has a lot of turnover by the fund managers. That means they're gonna pass those gains on to you, and you gotta pay the taxes on that in your tax bill. So utilizing passive investing instead of active investing can help with the overall return in your portfolio and your tax savings. If you're not certain that you've got these tax savings and taxable accounts set up and your retirement accounts maybe aren't set up the way you want, if up to this point you're starting to think, maybe I don't have it set up the way that I should, contact me below. There's an email below, thatcher@propathfinancial.com, or go to propathfinancial.com and click get started, and you'll be able to set up a free consultation with me to find out what to do next. All right, number 3 is actually broken down into 3A and 3B, and it has to do if you're a business owner. Say you're a high income business owner. You may have already known this or seen this if you've had your business for a few years, but being able to maximize business expenses is a great way to save on some taxes, because those expenses help to keep your business running and potentially flourishing. So make sure you're getting all the business expenses built in, and then you're getting them on your tax return so you can have those tax savings too. Let me give you some examples, some business expenses. I'm gonna read through them. Here's things that can be written off: advertising, car and truck expense, commissions and fees paid for contract labor, labor itself, depletion, depreciation, insurances other than health insurance, interest, legal and office expenses, rent or lease, repairs, maintenance, supplies, taxes and license, travel, meals at 50%, remember that, not 100% of meals, 50% of meals, utilities, wages, just to name a few of them. So make sure you're taking advantage of those expenses. All right, 3B is a proper tax election. LLCs, sole proprietors, partnerships, all those are business types, but they're not the tax election. You wanna make sure that you're selecting the proper tax election and whether or not your assets are passing through, or say, for example, you're a C Corp. So some options could be filing your taxes in S Corp, becoming a C corporation, or just staying a sole proprietorship where everything goes on your Schedule C and transfers over to your 1040. But the tax election can add a lot of value in how you get your tax savings now and in the future. All right, number 4, which is actually number 8, is your state's residency. If you're getting courageous or you're frustrated with your state, you can move to a different state that avoids any state taxes. Now, there may be other taxes involved, say property tax or sales tax or no sales tax. Those things could be adjusted, but you could potentially save a lot of money if you're courageous enough to move to a different state. And there are a few states that don't have any state tax, and I'm gonna name a few here. The states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. And those are state tax-free states, because you can't avoid federal taxes besides what we've talked about here today and what normally you can avoid in the tax code. But in general, federal taxes apply to all states. And number 5 is charitable giving. If you're charitably inclined, using charitable contributions can be a really valuable way to pay taxes. Things like appreciated shares in those taxable accounts that we spoke of before, you can move those to, say, a donor advised fund where you can take the full deduction, well, I shouldn't say full deduction, but you can take a large deduction on that money moved and be able to reduce your tax bill if you itemize. So one kicker, if you're gonna use charitable deductions of taxable dollars or already taxed dollars, you need to itemize your deductions for them to really matter. So that brings in bunching, where you can bunch gifts, like 2 years of gifts into 1 year to be able to maximize that itemized deduction and really help with your tax savings that year. If you have retirement accounts and you're over the age of 70 and a half, which I know some of you are, you can do what are called qualified charitable distributions, where you can start withdrawing IRA dollars, and instead of paying taxes on that distribution, you can actually send that directly to a charity and check with your custodian, because there's gonna be a specific process, and that money sent will not go on your tax return. So if you're charitably inclined, that's a great way to avoid taxation. Obviously, we've talked about a lot, and being able to save money on tax if you're a high income earner is gonna be really valuable. A lot of ways that you get taxed come from you creating activity in your investments and your savings when you're utilizing the money. So being able to think about those things years into the future can really help with that lifetime savings goal that we're looking for. If you have any other questions and you want to talk more specifically about your tax situation, some opportunities to save over the long run, feel free to contact me below. I'll be happy to help. I do deal with taxes a lot with my clients. It's one of the biggest ways that I add value. Thank you so much for watching. We'll see you next time.